Okay, so we'll be talking about green finance and climate finance today. There are loads of different ways in which we can approach this. And we chose one where we looked at the relationship between the carbon prices, which all of you, I'm sure, know in Europe are not organized as a tax, but are organized as a cap and trade system where pollution allowances, financial products, need to be bought on a market, and the secondary market prices fluctuate over time. And therefore, we can observe that carbon price through time, and we can also observe stock prices through time. And what we did is we looked at the relationship of the two and what they tell us about possible incentives for the firms whose stock is traded to actually decarbonize. Okay. This is a joint work with my colleague Tatiana from the JVI and our colleague Oscar, who is doing his PhD at WU. Okay, so that question I already asked, does the stock market provide an incentive for firms to decarbonize? And to answer that question, the first thing we started to look at is whether the fluctuations of the carbon price affect the stock prices or not, whether that relationship between carbon prices on one hand and stock prices on the other depends in some structural way on the emission intensity on firms. And you will see that, yes, indeed, it does. And is the relationship different across different industries, countries, and periods? And we'll see that indeed it does. And typically, the higher the carbon costs that firms face, whether by country, Poland, for example, is a rather carbon-intensive economy, or by periods, more recently the carbon price has risen. This means higher overall costs. Or by industries, and you will see that the power sector is submitted to a higher carbon cost than other sectors. So whenever we zoom in, that relationship that we describe is particularly strong. So the graph you can see here, that's the European carbon price. It's the EU ETS price, to be precise. So that's the cost of one emitted ton. And it's gone through ups and downs. Today, I think, or yesterday, it reached 100 euros, so even higher than this. But the period that we study is the blue period on that graph. It started very low for a number of reasons, in particular over-allocation. Too many of these rights for pollution were issued in the wake of the financial crisis in 2009. So they stuck around, everyone had too many of them. No one really bought them on the secondary market and the price was very low. And then starting from 2018, the price climbed very quickly from 10 euros or even less up to now 100 euros recently. On the back of two things, one mechanism that's called the Market Stability Reserve. I'm not going to go into that, but one mechanism that ensured that prices would stay a bit higher, that would adapt supply to the existing outstanding stock of allowances, and then just of the renewed climate ambition of the European Union. Okay. So our paper could be summarized like this. So if S is the stock price of a firm and tau is the carbon price, then what we will be looking at is whether S is some function of tau, and whether when tau changes and S changes, and we can identify that relationship, whether this tells us something about incentives. Okay. So relationship between carbon prices and stock prices has been studied in the past. The evidence from literature was, let's say, mixed. There was no clear evidence on the way in which carbon prices would affect stock prices. We believe that this is mostly linked to the fact that the past papers looked at the reduced time period, in particular excluding the last peak. And therefore, carbon prices were low, relatively stable. So maybe that was one of the reasons why you didn't see much. The other thing is most of the published papers only looked at a few firms. You will see that we looked at all the available firms, more than 300. And also those papers, they were not always very clear when it came to distinguishing clean and dirty firms. We would try to make this as nicely and as cleanly as possible. Sometimes those firms, those other papers, they would go into annual reports of firms and look at, do they claim to be particularly green or so? So it was more a qualitative indicator. Okay, so we have 9 years, we have 338 firms in 23 sectors. And when it comes to distinguishing clean, yes.
How did you delineate the clean firms?
Yes.
Sorry.
We're perfectly in line. I was about to say that. So we define the cleanness of a firm by calculating its emissions, its total emissions under the ETS. So there's a little caveat. You know that not all emissions are covered by the European ETS. So I'm not going to go into detail. Happy to talk about it later. But methane is not covered, for example, and some sectors are not covered. But all the emissions that are all the CO2 and all the other greenhouse gases that are emitted and that are covered by the ETS are reported in a centralized EU database, and we capture those. And then we put that into relation to the firm size. We use, I think, yearly operating income as a normalizing variable in order to have a variable that is comparable across firms. And the other thing that we do, and that you will see is very important, is we distinguish whether the emissions under the ETS have to be paid for or can be covered via free allowances. And some of you might know that within the ETS, a number of these financial products are not actually auctioned out for money, but they are handed to firms for free. The idea being that if a steel producer, for example, had to pay a price of 100 euro per ton for their steel in Europe, first Alpine would go bankrupt and we would just be importing our steel from the US or from Turkey where there is no carbon price. So at this stage, they're receiving these allowances for free. But we'll make that distinction and we'll play a role in the paper. Okay. I'm not going to spend too much time on this, but basically what we did is we looked at the EU database that's on the left side, and we tried to identify firms in there. And maybe, or at least one of the important contributions of that paper is the creation of this data set, which we also publish, and I'm happy to share later and explain later, where the EU database provides granular data on the emissions and costs and free allocation, but at a very, very granular level. So you can see, did the Simmering 2 Kraftwerk, how much did they emit, etc., right? But then making the effort to associate the Simmering Kraftwerk to Wien Energie, that is something that is not easily feasible within the EU database. And when it comes to much greater groups, and in our case, more relevant groups, because Wien Energie is not traded, of course, when it comes to OMV, for example, it's impossible to do this within the EU ETS database. And you have to go to, and we went to Orbis, that's a classic database of firms and relationships and ownership. So we aggregated all these little installations, they call them, these little emissive firms into bigger groups and at the level of traded groups, so publicly traded groups on stock exchanges. So this again, so we have weekly observations for 338 traded companies over 9 years. And importantly, we covered 95% of all the paid allowances. So we were not able, that's for transparency reasons, we were not able to match all of the installations of the EU database with Orbis because some of the data quality is not great and some of them are not easily identifiable. But what we can say is we cover 95% of all allowances. So we state that this is more than representative. It's nearly everything that was available in the ETS. And the number of companies that's included is more than 15 times larger than in any previous papers. Okay, so a crucial metric in our paper is what we call carbon intensity. And it's what I roughly described here. I'd like to go into it just a little bit more in detail. So we can compute for every firm in our database and every year what the emissions of that firm under the EU ETS are. That's the E here at the very top in equation 1. Okay, that's a number of tons. Okay. If we want to compute the cost to that firm, we need to multiply that with a price. Okay. Given that we don't exactly know, and we tried, but we did not manage to, I'm happy to go into detail more, we don't exactly know when these allowances were purchased. We assumed that all the allowances that are needed in year Y were purchased continuously throughout year Y, and therefore we use the average ETS price of that year. Okay? So we multiply it by PY. And then in order to have a variable that I can compare across firms, bigger firms, smaller firms, we normalize by a normalizing variables, which is the revenues here. And we've robustness checked that with other variables. So we have this indicator, which is basically, it's an indicator without units. No, it's euros divided by euros. It's a carbon intensity, right? And as I said before, you can also, and that's now equation 2, you can split that up applying the same equation and calculate the free carbon intensity. So the part of that cost that is covered with free allowances, a kind of subsidy if you want, or the one that is covered by paid allowances. Okay, so the actual price, the actual costs that a firm faces is really just the paid part. This is the thing that they have to purchase either in the secondary market or on in public auctions. So very quickly to describe a bit our data to get a feel. Paid carbon intensities tend to be very low as a fraction of revenues, as you would expect maybe. So you can see that on the left-hand side here, this is paid carbon intensity split up in different sectors through time. So you can see that most sectors, they basically have zero carbon costs, right? By and large, that's 0.0%, 0.2 maybe, okay? The only sector where there's an exception, where there's a difference, is the red line, and that's the power sector, the electricity sector. And this is linked to the fact that since 2013, the power sector receives nearly no free allowances anymore, hardly any, okay? Other sectors, such as steel or cement, they still receive most of their allowances for free. So just to give you an order of magnitude, the power sector on average in Europe pays nowadays between 3 and 3.5% of their revenues in carbon costs. But behind that industry aggregate, that sector aggregate, there is a huge variability, like often when you build averages, and that's the right-hand side. So this is not any longer presented by sector. This is really just every point is one firm. And you can see that the average is at 0, the mean is at 0, but there are a number of firms throughout the years that have significant carbon costs, reaching up to 25% of their operating income in the case of one Polish electricity producer.
I didn't look carefully enough on the previous slide. The revenues from sales from carbon allowances are accounted for where?
So if you receive them and sell them, it would be accounted, it would not be accounted in the overall metric, it would be accounted in the paid metric. So just in case the free allowances are higher than your actual emissions, the way in which we define the paid allowances would result in a negative paid allowances. So you know the emissions.
Negative expenditure for this firm in a given year.
Exactly, and you can see this here. You can see here, for example, or you can see here, there are a number of firms that have negative carbon costs, right? Because they received more free allowances than they had to hand in at the end of the year.
And how do you account for banking?
We don't. So by banking, I think you mean keeping the allowances on your books. We don't, and I'm happy to discuss about this later on. Right? So we really consider years independently from one another at this stage. Okay, so some cross-sectional variability. Fortunately, otherwise we would not be able to write that big. So the regression, we set it up as follows. So we regress, it's just a panel regression, normal OLS. We regress the stock price returns, the stock returns of a firm in a given week on a stock index. We chose Euro stocks, and we also eliminated all non-European firms from our data set just to be able to control with that Euro stocks index. And then we control also, I'll jump to the second line here, beta 4, we put in the returns of a number of commodities that influence the carbon price and that might also influence the stock prices to get that out of the way. We have fixed effects that are country month fixed effects, so every country for every month with a time fixed effect. And we have also an industry fixed effect at the top. And then the most interesting part is the second half of the first line here of equation 3. And that is we control for the return of the carbon price. Okay? And the return of the carbon price influences, if you will, I'm getting ahead of myself, or is related to the stock price via beta 2 here. Right? But the relationship between the carbon price and the stock price, we allow it to also depend on two further variables, which are the free and the paid carbon intensity. Okay, so we are asking, the first question, beta 2 here, asks the question, what happens to stock returns on days that the carbon price increases? Okay, if beta 2 is positive, then it means that they co-move, and otherwise they would move in opposite directions. And beta 3 paid and beta 3 free tell us whether that relationship changes as a function of the carbon intensity of a firm. Okay? And you will see it does.
So the sample comprises firms that are subject to carbon pricing.
Yes.
Not firms that are out of the regime.
Yes, it comprises firms that have at least one installation or that have a controlling share of at least one installation that emits something. Yet you could reasonably argue, given that most of the firms stick at 0, that to all intents and purposes, most firms are not subject. So I'll give you an example. For example, I think Société Générale, the bank, is in our sample because they have a controlling stake in some firm that has a controlling stake in some, but that's of course negligible for Société Générale. Their carbon intensity in our definition is 0, right? So we have a whole shade, if you will, from the Polish power producer that really just burns coal and has a huge emission and pays for that, down to some firms that happen to have some financial stake in an emissive company, but by and large are not affected. So when we look at, that's the bottom part here of this slide, when we look at what the partial derivative, what the relationship between the stock return and the carbon return is, we see that it depends then on beta 2, and that beta 2 is sort of the base relationship, and that beta 2 can be changed by beta 3 free and beta 3 paid, that is proportional to the free and the paid carbon intensity of the firm.
So why do you say carbon return when you mean a carbon price?
I mean the carbon price return.
Carbon price return, what is that?
It's the change in carbon, the relative change in carbon prices. Yeah. Yes, sorry, that's a jargony. So it's our carbon, and I maybe should have been more explicit about this, is defined in exactly the same way as the relative change in the carbon price, in the same way as the stock return is defined as the relative change of the stock price from 1 week to the next.
So you differentiate twice here, right? Because you have fixed effects in the IoT, fixed effects. Twice differentiated in a sense, no?
No, because the fixed effect should not depend on the carbon price change, right?
Yes, but having the fixed effects in there is like having a differential equation, right? And yet you do differentiate the carbon price.
If you will, having the fixed effect is like taking out the mean to some degree, right? Yes. Yeah.
Yeah. It's the surprise increase or something like that. The carbon price.
Yes. I mean, I would maybe not say surprise. It's just the fluctuations around the carbon price. I'll come to it. I'll have a part on surprises later where we specifically look at dates where there was news and where the carbon price changed. Okay, so the result of that regression is as follows, and I'd like to start with beta 1 here. That's the Euro stocks. It's very significant, as you would expect. Stock prices of individual firms depend a lot on the Euro, co-move a lot with the Euro stocks. That's no surprise. An increase of the Euro stocks of 1 leads to an increase of the stock on average of 0.9. It's just the base that you would expect. More interesting is beta 2. So what happens to the stock price when the carbon price increases? It's very significant and it's positive. And this might be surprising at first, and I'll come to it a bit later. So the average firm the average firm with 0 carbon intensity sees their stock price increase when the carbon price increases. That might be a bit surprising at first, right? Because you could think, well, that firm has no carbon intensity, is not affected. It should just be 0, right? We'll come to it a bit later, but basically, in some of you, I see that you're nodding. It's related to windfall profits. So if the carbon price increases, for example, the power price will increase because most power producers can pass on that cost to final consumers. Now, if I'm a firm with 0 carbon intensity, I still benefit from that higher cost. I can still sell my product that I produced with 0 carbon intensity and 0 carbon cost. I can still sell it at a higher price. And so this is why, or at least it's an explanation, we don't show it empirically, but it's an explanation why firms with 0 carbon intensity still benefit from increasing carbon prices. Interestingly, and that's maybe the most interesting part of the paper, is that beta 3 paid, the interaction with the paid carbon intensity is negative and very significant. And that just means that the more a firm has the higher the carbon cost of a firm, the more negatively will its stock price be affected on days when it rises when compared to a firm with 0 carbon costs. So, or to say it in other words, a rising carbon price is related to a wedge that opens up between clean and polluting firms. Because a dirty or polluting firm will see their stock price increase less or even decrease when the carbon price rises. And the third interesting result of the paper is the third line here, namely that beta 3 free is non-significant. To say it in other words, it doesn't matter what a firm emits, right? That does not matter in the relationship between carbon prices and stock prices. So investors don't seem to price in on any given day what a firm emits. The only thing that matters is how much it has to pay for it. Okay? And I'll come to that later in the policy discussion when it's about carbon pricing versus transparency exercise. So two firms that one emits a lot and the other one emits the same amount but gets all of their allowances for free, that second firm will not be punished, will not see its stock price decrease on days when the carbon price rises.
Is that the right hypothesis? Shouldn't we not expect that the companies that get permits for free should see stock return increase, because what they get for free has a higher value? No? If the price is higher, they can sell it.
Yeah.
Sell it and make money on it more than before.
I would argue no, because what they get for free is both an item on their asset side and their liability side, right? It is something that they will have to hand in at the end of the year. So it's true that you have these assets sitting on your asset side and the value of those increases when the price increases, but the value of your liability increases and it offsets it.
And in how your emissions develop.
Well, that would be in the future. Like, we look at years that are already final. We know what the emissions indices were. And so the free allocation is basically not an asset. It's neutral finance-wise. And if you receive more allowances for free than you would have to hand in, that is accounted in our paid metric that can turn negative, right? So in a certain sense, if indeed you receive more free allowances than you have to surrender at the end of the year, and the price increases, you gain from it, right? And we will see that actually you do. Okay, so this is summarizing what I've basically just said. So the change of a stock price, and that's the equation here in the middle. Sorry, the equation here in the middle. The change of a stock price in the week where the carbon price increases is beta 2 plus beta 3 free times the actual free carbon intensity plus beta 3 paid times the actual paid carbon intensity. We've seen that beta 3 free is 0 empirically. And so the relationship is the one that I've put here, which is interesting because we can interpret it in a different way. Namely, as soon as your carbon intensity exceeds 1.7% in that model, in that result, then the firm's stock price no longer increases in the face of an increasing carbon cost, but it starts to decrease even. Okay. This is just a graphical representation of what we have here. So you have the carbon intensity, the paid carbon intensity here. It can be negative, it can be positive, and this is the impact of a 1% rise in carbon prices on the stock price. Okay, so at 0, you're slightly positive. It's what we discussed. Then there is this inflection point at 1.7%, where actually the impact starts to become negative. If you're in negative territory, you really just gain from an increase in carbon prices because of what you just mentioned. And if you have a carbon intensity of 10%, an increase of 1% in the carbon price is related to a 4 basis point decrease of your stock price.
Sorry.
Yes.
Regarding your slide before, could you tell us where is the mean of the paid carbon intensity in your sample?
It's de facto it's 0.
It's around 0.
Most are at 0. And then some of them go out until 25 and some are slightly negative. So
among the non-zero carbon intensity firms, do you know?
It's difficult to say. I think it's basically the answer of your question is looking at that graph, right? So okay. They all sit at 0 and nearly 0, and then there are some outliers up to 25%. Okay. Just keeping track of time, I'll skip that one. We did an event study because so far we just correlated things, right? We don't know anything about causality, right? And we can tell a nice story that it is probably the carbon prices that influence the relative performance of the stock prices rather than the relative performance of the stock prices that influences the carbon price. There is no economic argument for that. But just to be sure, we made an event study and we looked at dates in which there were news that were related to the supply of allowances and therefore changes in prices, right? And we looked at whether on those dates the relationship still held. And we found that indeed, not only is the relationship still there and statistically significant, it's even from an amplitude point of view stronger than what we saw in the overall sample. Okay? So I think we have a good case, not only telling a story, but also looking at this event study of saying that there is some form of causality going from carbon prices to stock prices or to relative stock price performance. Okay, we also looked at whether the effect that we saw is permanent. So we added lagged versions of the carbon price. Just in theory, you could imagine, that there is a strong peak in carbon prices, but that the wedge that I was telling you about then contracts again and cancels out in a week afterwards, but we don't see this. Okay, so this is the graph in the middle here. The first parameter is statistically negative, so the wedge opens up, but all the other parameters here are non-significant. Okay, so I'll come to the conclusion. We built this novel data set of these firms, and we find a strong and statistically significant relationship between the carbon price changes and stock returns. And that relationship depends on the paid carbon intensity of the firm. It does not depend on the free carbon intensity of the firm. If we consider this and we assume that there is causality, then what we have is actually an incentive channel. Because under any future path of increasing carbon prices, which most people expect, a firm can then quantify its own relative underperformance with respect to zero carbon or just other peers, right? In the future, because of that wedge, right? There will be an underperformance of highly polluting firms. And then I'm not saying that this would immediately lead to decarbonization, but at least a firm can put a number on what it would cost its stock price if it does not decarbonize. And that informs the equation of necessary investments for decarbonization and financial benefits. That would be one. And I think maybe what's most convincing about this incentive channel is that most CEOs, and then shareholders, of course, they are often paid depending on their relative performance of their own stock price. And so they would see that immediately in their own pockets. So we consider this as being a possibly quite powerful incentive channel. So what about the policy implications of this? This is my last slide. Well, if we believe that there is this incentive channel and we want to strengthen it, then we need to increase the carbon costs. We need to get CI paid further up, right? How to do this? Well, first, either by increasing the carbon price, right? We can't really do this explicitly because it's a cap and trade system and that's traded on the markets. But we could either have a floor. I think Denmark and the UK introduced that, or we could change the market stability reserve to have higher prices. We could also phase out the free emissions alongside some kind of carbon border tax in order to protect European industries from non-European competition that would not be subject to the tax. But that would be another thing. Like if we move all the free into the paid, CI paid would just mechanically go up. Right? And then the third point that we could do is that include sectors that are currently not included in the ETS into the ETS. That would also increase those firms' CI paid from currently zero to something positive. So that's the first policy conclusion. The second one would be that we have here both a carbon pricing scheme, but we also have a quite good disclosure scheme. No, we're all talking about we need to make sure that firms' emissions are well known and reported in a comparable way, and everyone's complaining about the fact that this data does not exist, and that's true. But here is a small example, but non-negligible, of all European power producers and manufacturing firms that already had to report in a structured and comparable way all their emissions back to 2005. Okay, this is audited. It's not just me reporting something. It's really actual physical emissions that are reported. Well, what we can say, and I don't want to overstress this because we're only looking at one kind of relationship, but this relationship here is not affected by emissions. It's really just affected by costs. Okay, so the idea, and this is a bit related to this climate finance discussion, the idea that by the sheer publication of emissions, somehow dirty firms would get punished by investors just for being dirty. I mean, you can think about this what you want. I personally am very skeptical about this, but at least very concretely in this relationship, we don't see anything of this, right? Investors in stock markets here don't reprice from 1 week to the next, depending on emissions, they reprice depending on costs. Okay, and the final point is that we believe that there is no, I mean, I don't want to overstress this again because financial stability is a complicated topic, but let's say this. We do not observe a stock price drop when carbon prices increase. We don't see anything like carbon prices increasing, systematically driving down stock values. We don't see a stock crash from carbon prices. It could happen under some non-linear scenario, some cutoff, of course, but at least now, if anything, we see that stock prices go up when carbon prices go up, because at this stage, firms are able to pass on their costs. I'll skip the next steps, happy to talk about this. And I thank you for your attention and thanks for your questions.
Well, I think we should jump to your comments.
Okay.
Do you have any slides? No. Then
Just notes. Thank you for the presentation and for handing in the very interesting paper that I had the pleasure to read. Before starting into this discussion of the paper, I want to cite the Financial Times from yesterday. And the head of CEO of Vanguard, an important mutual fund, said that we believe we should not dictate company strategy. We do not know the right strategy for thousands of firms in our portfolio. And for this reason, Vanguard pulled out of the Net Zero Asset Managers Alliance. Right? So they don't see the value for them in this. And we want to make sure risks are appropriately disclosed and every company plays by the rules. Yeah? And finally, Vanguard is not in the game of politics. So a very big institutional investor pulling out of this alliance gives a bit of a signal that ESG is a bit in a crisis, I would say. Well, what is the big contribution of this paper? I think there's an enormous effort running into data collection and matching that's behind these numbers that we have seen, and that's really interesting. And maybe you can elaborate a little bit about what were the problems when you matched the EU ETS data with the Orbis database, because we are also using Orbis here at the Institute, and that might be useful for us. Well, the main contribution of the paper is an expansion of the sample in the time dimension, so adding the years 2018 until 2021, adding to the sample in terms of sectors. The previous studies have been concentrated on electricity production. And now we have also chemical industry and banking, I've heard, and other industries in the sample. So that's the other extension. And this very important term of the paid allowances. So we have firm-specific quantitative measures of the costs of carbon emission certificates. And I think this is very important because even in the same sector, you could apply very different technologies. For example, in electricity production, you can have coal-fired plants and you can have nuclear power plants, both having very different emissions of carbon gases. So that's very important. I think that's really the thing that you should put into the window if you present this. Okay, now what might be interesting if you think about the results here is there are still 4 phases of the EU ETS trading system. The first running from 2005 to 2007. having fully free allocated permits, right? There were no costs associated with this. Then 2008 and 2019, phase 2, 90% free allocated. And then third phase starting in 2013, running to 2020, with a gradual replacement of free allocation to auctioned allocation. But I've seen somewhere in the internet that manufacturing still gets 80% of the permits for free. So that's the reason why you have so many zeros in the distribution figures. So we have still a period with largely free allocation of permits. And then you have these political interventions of the Market Stability Reserve, where after the economic downturn in 2008 and 2009, there was an excess supply of permits, and the Commission tried to get that out of the market. So I think your conclusion is a bit strong that you draw from your paper when you say we find and we can prove that there is a negative effect of carbon prices on the stock price of firms. And there are some, I can explain why I think this is too strong. First of all, you did not present this, but in the paper you have a very nice table 2. And in the table 2, you see it's only the electricity firms that drive the result. No other sector that you have displayed has a significant parameter. So it's only the electricity sector that drives the result. If you look at the electricity sector, you have another nice table. I think it's table 4. It's mainly the electricity firms active between 2080 and 2022 that drive the negative beta 3 element. So what you see mainly is electricity is affected by, electricity stock prices are affected by the carbon pricing scheme, and no other sector, and also only in the time between 2018 and 2021, right? So I think you should narrow down your conclusion to this rather than saying there's a negative relation between carbon prices and stock prices, and especially because if you look at the 2 parameters, you have a very small beta 2, 0.009, and a rather large beta 3, 0.5. But if you multiply the 0.5 with your CI paid ratio, the 0.5 end up being smaller than 0.99909, and you end up with almost all the firms in your sample having a positive price effect from the carbon pricing scheme, right? So it's quite contrary to what you signal in your conclusions, what you can offer as results, and I think you should put that right. Okay. Yeah, you were looking at weekly returns, and I think what you have shown is that investors who are taking account of information costs and bounded rationality and things like this will not pay attention to carbon prices as long as they do not matter, right? And if they start to matter, if you have an average carbon intensity of 3%, which is the electricity industry, but they do not matter if it hovers around 0. But that's, you can ignore this. That's fairly rational to do so, and it actually happens, I think. And what I find surprising, and that can be interpreted as a kind of irrationality, is that investors obviously do not pay attention to the amount of emissions that is emitted, because if you think of, as you motivated your results, you are thinking about the future profitability of the firms. So you have the future revenue path, you have the future cost path, and the future cost path should be more subject to carbon prices if they are more and more auctioned off, and if carbon prices get higher. So this signals somehow that there is not a lot of rationality among investors in this market. And maybe I have some more technical points, but one that I want to raise. There was an interesting paper by James Hamilton. I'm serious econometrician, and he was looking at the effect of oil prices on GDP growth. And he had a very smart transformation of the oil price in his regression equation, and that was he was taking the difference between the current price of oil and the over three-year horizon, the maximum over the past 3 years. And if this difference is above zero, he would take the difference as a smart dummy, so to say. Otherwise, this is zero, right? So you have a very non-linear way, and that might capture your long period of rather flat prices from 2012 to 2017, and then the increase from 6 to some 80 or so that you have. But you would have always prices above the past 3-year interval that then allow you to merge the data from the past, which are now more or less insignificant, with the data from the last years that are driving your results anyway. Okay, that's for my time. Thank you.
Thank you very much.
Thank you very much, Thomas. Do you want to answer?
Yeah, I can answer quickly. So thanks very much. I'll just bound myself to the 3 very important points of criticism that you proposed and presented, and thanks very much for those. I hope I have convincing arguments for each of them. And I will go back to the slides.
Let me share the screen again.
Okay, so just summarizing, the 3 points of criticism were that indeed we established a relationship everywhere, but when we drill down, we see the relationship statistically significant only on the power sector, not on the other sectors. That's the first point. The second point is that we are not actually seeing a negative impact of carbon prices on stock prices, but rather overall a positive impact. And the third point is that you questioned the rationality of investors on the free part. And I completely understand. Wait, maybe let me answer first to point number 2. So I think, and I'll come back to the regression result. So I agree with you that beta 2 is bigger than beta 3 multiplied by actual CI paid very often, right? I think, though, that the interesting part of the paper and the interesting part of the incentive channel is not so much beta 2, but it's always about relative performance, right? So it's always about the stock performance of firm X with respect to competitors or with respect to the market. And for that, we don't really need beta 2, right? Beta 3 is sufficient, right? So as long as beta 3 is positive, and then in commas, when we look at more recent periods, beta 2 actually turns out to be 0 and beta 3 is even more negative, right? But the point that I'm making is valid on the entire period, that the relationship that we uncover here shows that dirtier firms that have higher carbon costs, underperform with respect to firms that have lower carbon costs when carbon prices rise. And I think that's sufficient for me to establish this incentive mechanism, because very often you compare yourself in terms of stock performance to the market or to competitors. So that would be my response to the second point. On the first point, I agree with you. I can't say anything. I mean, we don't find results on mining. We don't find results on chemicals, etc. The explanation that I have for this is related to a point that our colleague raised at the very beginning about banking, and I didn't pick that up, and I would like to do it now. And it's basically, if we think about what happens to the value of a firm price in the face of a rise of carbon prices, right? There are different things that happen, right? We basically, in this paper and in my story that I was telling around it, only highlighted the higher costs. But there are other things too, right? If you have banked a lot of allowances that you did not use in the past, they're sitting there on your asset side of your balance sheet, they increase in value, right? We did not manage, unfortunately, to build a good database of what the stock of allowances of each firm was through time. Therefore, we could not account for that. But that's a noise term, right? It's just adding noise to our data set. Take an example, RWE, the big German coal power producer, they publicly announce as often as they can that they hedged out either via banking or via futures contracts. They hedged out all their carbon risk. So they covered all their future allowance needs for the coming 20 years until 2050. And so they should not be affected, right? We don't capture this. For us, that's noise. So RWE, for us, we only see their actual current paid carbon intensity, which is positive, right? And then there are other effects too. You know, if you're a firm and you don't emit anything, but you buy a lot of electricity, for example, well, your electricity input becomes more expensive when carbon prices rise, right? So input costs also depend on the carbon price. That's again a noise term that we don't capture. And finally, it's this pass-through argument. Different firms will be able to pass their additional carbon costs through to consumers to varying degrees. And we don't capture that. So where I want to come to is, I think there is a lot of noise in the data set that we have here, because we don't control for every little bit of impact of carbon prices on stock prices. And the thing is that as long as your paid carbon intensity is not high enough to dominate that noise, you will not see anything, right? You will not see anything, and therefore the results will be statistically non-significant, is my expectation, because you will be just drowned in all the stuff that we don't control for, right? The good news on that is we managed in the end to build a new data set for our next paper where we control for banking and for financial hedging and for pass-through of costs and for future decarbonization plans. And hopefully we'll be able in the coming months to test the hypothesis whether we can see something, even if the paid carbon intensity is a bit low. But I will keep you posted if you want on that. Yeah. And the last point about free allowances, I agree. I was also a bit surprised. The only glimmer of hope there is that in our event study, we studied the dates in which there were announcements that changed the supply of allowances and looked at how the relationship changed on those days. We specifically looked at those days where the regulatory changes affected free allowances, meaning very often that there were fewer free allowances, right? And if we look at the relationship just on those dates, then the CI free factor becomes significant and negative. So I don't know if we're picking up noise. It's very significant. So, but what the results would tell us is that investors on those dates where suddenly there is a change to the free allowance part, they punish firms with loads of free allowances because they think that in the future those might have to be paid for. So that would be my answer to the last point. Thanks.
Thank you very much, Laurent. We have three comments from the audience. Let's start with Gabriel, please.
So first of all, thanks for a nice paper and a nice discussion too. Very interesting. I have a couple of comments. The first is on the econometrics. So I think what you're essentially doing is indeed running a double difference equation. And so you do not identify the effect of a change in the ETS price on stock prices, but the change in the change of the carbon price on the change in the change of the stock. And because that, you can transform the equation simply by first differentiating it to see that. So I think you shouldn't do that. Or at least run the robustness without doing that. You do stack the card against you by using this. I would believe. The second question is around banking and hedging. It would be nice. I mean, now if you have your second project running, that's even nicer. Maybe it would be nice to work out how banking would affect your beta coefficients. And my strong guess is it would attenuate those because you have noise in the paid measure, right? Having noise in there attenuates the betas, and I think that's something that referees would love to see. It helps them understand what you're doing. And the third point, I guess, is when you say incentives. When the ETS was introduced and free permits were decided, economists said that's great. The free permits aren't the problem because incentives to decarbonize are there anyways, right? Now, that might well be the case, right? You're not saying that this is not happening, but I would suggest when you say incentives for decarbonization, you should be careful because, you know, the fact that there is a positive carbon price out there, even if you get free permits, that does produce, hopefully, if we as market analysts are right, you know, it should affect behavior and have strong incentive effects, even if it does not affect the stock price, which is not a marginal concept, but an inframarginal one. So, okay, that's it.
Thanks. Yeah, so on the double difference, I would have to look into it more. I don't see things like this, but maybe we can take it afterwards or another point. I'll take a look at this point. I agree with the hedging point, and on the incentives, it's true. We try to. I wasn't maybe as careful in my presentation, but in the paper we try to always talk about stock market incentives. So of course the overall incentive is always there, and even if you get something for free, if in theory you could sell it on and decarbonize at a lower cost, you still have the incentive to decarbonize in that sense. That's true. So we are really looking just at that small additional incentive channel, if you will.
The second one was Angela.
Yes, thanks for your presentation. I wonder, since the sectors are treated so differently in the ETS, and namely only one sector has to auction their allowances, I wonder whether your results would become a bit more robust if you just concentrate on the electricity sector, as also Thomas mentions. And then I wonder, wouldn't it be interesting, instead of differentiating the clean and dirty firms, as you do, which is mainly, do they get free allowances or not? And in the electricity sectors, there's really a very small part of the companies. It could also be interesting to compare them with different technologies of electricity production.
Perhaps given our time, we collect the inputs, okay? So the third one was Franz, I think.
Yeah, it's just comments. I do not ask for any answer. The presentation is great, and in particular great is the fact that you provide the data set that can be used for many other purposes as well. That's really good. And one comment to Thomas regarding the rationality. Maybe people are rational. They just consider on the line, maybe kicked out, may not be the next president of the commission. And maybe there happens another event and policymakers decide that there will be free allowances again. This could happen. It's just a comment to your comment.
Thank you very much, Laurent.
May I add one small question? Is it necessary to put the number of bought emissions into an annual report or additional to the balance sheet of the company? Is there an obligation to do so?
To a certain degree, yes. It's even that it's part of. You mean at the aggregate level of the company?
Yeah.
Good question.
So
I would argue no. The obligation is at installation level, and then you have to reconstruct it upwards. Is your question implying sort of could we check the numbers?
Is there any obligation to disclose as a firm being on the stock exchange to how many permissions you have to buy and how you hedge this activity or not? I mean,
I don't think so. So happy to take it more in detail afterwards, but there is the NFRD, the Non-Financial Reporting Directive at the moment, and I think that's not very structured, and you can really put in your report you can publish that in a very free version. But now we are moving into this corporate sustainability, CSRD, Corporate Sustainability Reporting Directive, and from then on, at least the emissions themselves will have to be reported in a very, very precise and methodologically accurate and coherent way. Whether also the purchases will be in there, I don't know.
I mean, they will be on your balance sheet somewhere because it's costs for your firm.
Yeah, that's one thing that they are hidden in some number.
Yeah.
or whether they are explicitly stated.
I mean, in many companies, they publish if they have costs for purchasing.
Okay, my dears, we are running out of time. I would love you to answer.
Yes, I will do that.
And then I have to.
Yeah, so I agree, and we present the results for the electricity, and it's a great idea to look at the production. Yep.
Oh, thanks.
That was
really fast. Thank you very much for joining us today, and have a nice afternoon. It was my pleasure.
Great.
To have you here.
Yeah, thanks very much.
Thank
Thanks for your attention and your comments. And if ever you have any question or any project or any ideas to discuss, please reach out. I'm always happy to